Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that is just making an exceptional recovery here from its low. I believe I posted the last video on the S&P 500 right here, right near the bottom at around 4,100 points. It was just the perfect market panic. I can't tell you the number of comments, the number of questions I had from the members on the website that asked me if they should be selling their stocks in light of the Russian-Ukraine crisis. Now that's exactly why we came out and made two separate videos, a premium video and a YouTube video to calm down the panic and take a look at the brighter side of things. So far, this has played out. We've had a capitulation move down and this big head and shoulder pattern that we've been watching. Well, it broke down throughout the day and now it's snapping back up, right? So that's called a false breakdown, and that's a pretty bullish thing. Now, this is a typical play from big institutions. They know everyone's watching this pattern. They know that a lot of people have placed their stop loss just below that low here, and so they take the market down through the stop losses down to the next level of support and then snap it back up. So in this video, we're going to take a look at a few different data points, take a look at whether we should still be optimistic regarding the future of the stock market. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. Also, don't forget to smash the like button if you enjoy this episode. Now, without further ado, let's get right into it. All right, so as we've been talking about throughout the past couple of weeks, as we've seen these markets make this sideways pattern, one of the things we've been focusing on is the bullish narrative, is the current sentiment, right? Every time I make a bullish video, I make a bullish statement, I have a lot of pushback, a lot of people that don't see how the markets could get back to the all-time high. The overwhelming narrative out there is that the Fed is going to have to fight inflation this year in 2022, and that's absolutely true, but the problem that I see is that this narrative is going too far here. When I see this type of situation here where all big banks are forecasting 5, 6, 7 rate hikes in 2022, JP Morgan just came out and said that they expect 9 rate hikes. So it really is that typical situation where the banks try to feed off the panic that is currently occurring in the market. I think there's a reasonable chance that investors begin to realize that we're not going to get 9 rate hikes in 2022 and that perhaps the Fed is going to start focusing on a weaker economy. If you take a look at the freight shipment index, so a measure of transportation in the economy, this is one of the things that we look at as a leading economic indicator. And you can see we're starting to see weaker numbers here in terms of the year-on-year change. We're seeing some signs of a slowing economy here, which is ultimately going to fuel a switch from an environment where everyone's saying the Fed is going to tighten, to all of a sudden, maybe the economy is weakening and the Fed is going to start, and the Fed is not going to tighten as much. And I'm going to show you this in another way here by taking a look at the yield curve. This is the 10-year minus the 2-year. Seeing the yield curve come down significantly like this, this is a type of tightening. The 2-year, so short-term rates are rising a lot faster than long-term rates. That is a form of monetary tightening. And that's why eventually once that inverts, it tells you you've had tight economic conditions for a significant amount of time, and it increases the odds of a recession just like it did in the late 90s, just like it did in 2007, although that of course coincided with a global pandemic. But the point I'm trying to make here is that we've had a form of strong monetary tightening just by the bond market, by the natural dynamics of the financial markets. And you can see we're at the same level here where we were at back here in June 2018 and in mid 2005 as well. If we add the federal fund rate on top of this chart, you can see this was already towards the end of the tightening cycle, and the Fed in 2018 could actually only raise the federal fund rate 4 or 5 times before the economy weakened too much and they had to ease again. So the point I'm trying to make here, not only are we already seeing very early signs that the economy is weakening from this tightening dynamic that we've had and the stronger dollar that we've had, but if we just take a look at the yield curve, it's telling us that we're already very, very late in the economic cycle, and the Fed hasn't even made its first rate hike yet. So the idea that they're going to be able to make 9 rate hikes in 2022 is just absolutely ridiculous. At least that is our personal conviction. And I believe this has fueled way too much panic over the course of the past couple of months. If you were on our website back in early January, as the markets were making new all-time highs, we made 4 points on our short-term rating of the S&P 500. First of all, that momentum was weakening, and that's a sign of short-term corrections. That breadth was extremely weak, with only a handful of stocks participating in the S&P 500 rally, and that the Fed had recently announced an earlier than anticipated monetary tightening, and that could provide the fuel for a short-term correction. So you see what I mean here? I find it absolutely absurd that investors are now concerned about the Fed tightening, but back here, when we were saying you should be concerned about the Fed tightening, people were telling us that the markets were ready to absolutely skyrocket into a massive rally. I think now is the time to start looking the other way, especially as you see this type of data here. And this is the bullish sentiment that has fallen to historic lows, right? We've discussed that before. This is the AAII survey. When it's extremely high, many people are bullish on the stock market. When it's low, few people are bullish on the stock market. But what's interesting about this chart is that it's combined with cumulative equity flows. And you can see every time that you see a bottom in the sentiment, every time you see a bottom in equity flows, and you eventually see a rise in the amount of flows. And that makes sense. As sentiment improves, you start to see more money come into the stock market and fuel rallies. Now you can see here we're still extremely elevated in terms of equity flows, but the correlation hasn't broken, right? We had rising equity flows as sentiment was rising in 2021, as sentiment was rising late 2020, and then throughout 2021 it came down with the sentiment as well. And now look where we are. We're at the bottom. The narrative is overwhelmingly bearish. If we have an improvement in the sentiment, we'll have an improvement in equity flows. And, given the amount of liquidity that is flowing in the financial markets right now, that has the potential to provide some pretty big and impressive fuel to an equity run. Now, of course, we're not going to get everything right, but the point of our service at gameoftrades.net, and particularly these Game of Trades ratings across asset classes, is to give you guys up-to-date information on the market, and most importantly, try to think differently from the herd, right? Nobody was looking at the breadth, nobody was looking at monetary policy back then, because when the markets are at all-time highs, everyone wants to look up. And now we're seeing the exact opposite thing happen. Everyone thinks they've got this Ukraine situation. Everyone thinks that all of a sudden they've become experts on how monetary policy works and that the Fed is going to crash the markets. That's when you have to look the other way. So if you want up-to-date, original information and research on the market, make sure to click the link in the description down below. We'll be posting another Game of Trades ratings across asset classes on Monday, where we give you guys our ratings across all assets, short term, intermediate term, and longer term. Now, one more thing I want to take a look at here is the VIX. The VIX just continues to be such an accurate indicator of when to step in and buy the market, right? Look at this open here on the VIX at 37. It was at resistance. If you watched our premium video from the other day, you'll know that the VIX has only done this a handful of times, and we went back and looked what happened with equities every time this happened. Forward returns are exceptional when you have this type of volatility in the market, right? What's the VIX? The VIX is volatility. So when volatility rises, that's when stocks are going down. Look at this. This is COVID. COVID volatility spiked as the markets were falling. So if volatility, if the index is extremely elevated, it leaves a lot of room for it to go down and for the markets to rally. Because as volatility is coming down, markets tend to rally, right? For example, right here, this extreme high in March 2020, the volatility spiked all the way here. That was pretty much the bottom of the COVID-19 crash. And it was right there at the same top as 2008. Now, it's not perfect, but it's almost perfect timings of these major bottoms. And the same principle applies to smaller corrections, and that 40-point level on the VIX is often a great place for volatility to calm down and for an equity rally to take place. Now, all of this is very biased, of course. And short term, we're still seeing rising volatility. So could we see one more leg down? Anything can happen in the markets. Same thing with the technical picture on the S&P 500, right? We're making a series of lower highs and lower lows. So given everything we're looking at, all the research, we're very optimistic. We were very clear as the markets were tanking here. We're buying the dip, especially the technology sector and small caps. But it's not until we have a proper breakout that we can expect short-term upside. So I guess that's what I want to end with. I hope you guys enjoyed this episode. If you did, do not forget to smash the like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.